Welcome to our deep dive into behavioral economics and market anomalies. Today, we'll explore how cognitive biases shape financial decisions and how you can exploit these biases to understand market anomalies. Behavioral economics blends psychology with traditional economics. It studies why people make irrational financial choices, unlike classical economics, which assumes rational actors. Behavioral economics recognizes emotions and biases drive decisions. These biases create market anomalies like bubbles or crashes. Let's start with what behavioral economics is. It's a field that examines how psychological factors affect markets. Traditional economics assumes people always act in their best interest. But real-world decisions often defy this logic. For example, why do people panic sell during a market crash? Or why do they chase overhyped stocks during a bubble? Behavioral economics explains these through cognitive biases. Cognitive biases are mental shortcuts that skew our judgment. They're hardwired into how our brains process information. These biases lead to predictable errors in financial decisions, and those errors create opportunities in the market. Let's look at some key cognitive biases and their effects. First up is confirmation bias. This is when people seek information that supports their beliefs and ignore data that contradicts them. Imagine an investor who loves a particular stock. They'll focus on positive news about the company, but dismiss warnings about its declining performance. This can lead to holding on to losing investments too long. Confirmation bias fuels market inefficiencies. Savvy investors can spot these mispriced assets. Next, let's talk about loss aversion. People feel losses more intensely than gains. Losing $1,000 hurts more than gaining 1,000 feels good. This bias makes investors overly cautious. They might avoid selling a stock at a loss, hoping it will rebound even when evidence suggests otherwise. Loss aversion can create undervalued stocks. Traders can buy these at a discount and profit later. Another common bias is the herd mentality. People tend to follow the crowd. If everyone's buying a stock, others jump in. This can inflate prices beyond a company's true value. Think of the GameStop frenzy in 2021. Retail investors drove the stock price to absurd highs. Herd mentality creates bubbles ripe for exploitation. Contrarian investors can short overvalued stocks or buy undervalued ones ignored by the crowd. Overconfidence bias is another big player. Traders often overestimate their knowledge or control. They might take excessive risks, expecting to beat the market. This can lead to overtrading or poor risk management. Overconfident traders create volatility. Disciplined investors can capitalize on their mistakes. Anchoring bias ties decisions to irrelevant reference points. For example, a trader might fixate on a stock's past high. They'll assume it's undervalued if it's below that price, even if the company's fundamentals have changed. Anchoring can distort asset pricing. Smart traders look beyond these arbitrary benchmarks. These biases don't just affect individual investors. They shape entire markets, creating anomalies. Market anomalies are price movements that defy traditional models, like the efficient market hypothesis, which assumes all information is priced into assets. But biases create gaps between price and value. Let's explore some real-world market anomalies. One famous anomaly is the momentum effect. Stocks that perform well tend to keep rising, while losers often continue to fall. This contradicts the idea that markets are fully efficient. Herd mentality and overconfidence drive momentum. Investors pile into trending stocks, pushing prices higher. Traders can exploit this by riding the trend, but they must exit before the trend reverses. Another anomaly is the value effect. Undervalued stocks often outperform glamorous ones. Investors overlook these stocks due to biases like familiarity. They chase well-known companies instead. Value investors like Warren Buffett exploit this. They buy cheap stocks and hold for long-term gains. The January effect is another curious anomaly. Stocks, especially small caps, tend to rise in January. This may stem from tax-related selling in December, followed by reinvestment in the new year. Traders can position themselves to capture this seasonal boost. Post-earnings announcement drift is another anomaly. Stocks with strong earnings often keep rising afterward, while those with weak earnings continue to drop. They're slow to adjust to new information. Traders can profit by acting quickly on earnings reports. These anomalies show markets aren't always efficient. Human psychology creates exploitable patterns. Now let's discuss how to exploit these biases. First, recognize your own biases. Self-awareness is key to avoiding common pitfalls. Keep a trading journal to track your decisions. Review it to spot patterns of bias, like overconfidence. Second, use rule-based trading systems. These remove emotion from your decisions. Set strict criteria for buying and selling. For example, use stop-loss orders to limit losses. This counters loss aversion and emotional trading. Third, diversify your information sources. Don't just read news that aligns with your views. Seek out contrarian opinions to challenge your assumptions. This helps mitigate confirmation bias. Fourth, focus on fundamentals over sentiment. Analyze a company's financial health, not just market hype. This avoids getting swept up in herd mentality. Fifth, exploit anomalies with disciplined strategies. For momentum, use technical analysis to spot trends. For value, look for low price-to-earnings ratios. For seasonal effects, time your trades strategically. Let's look at a case study to tie this together. Consider the 2008 financial crisis. Herd mentality drove housing prices to unsustainable levels. Investors believed prices would keep rising. Confirmation bias kept them ignoring warning signs, like rising default rates on subprime mortgages. When the bubble burst, loss aversion kicked in. Investors held on to collapsing assets too long. Smart traders like John Paulson saw this coming. They shorted mortgage-backed securities, earning billions by exploiting these biases. This shows how understanding biases can lead to profits. But it's not just about exploiting others' mistakes. Behavioral economics also improves your own trading. By recognizing biases, you can stay disciplined and avoid emotional traps that cost you money. Let's talk about recent developments in this field. In 2023, research showed biases persist across economic groups. Even low-income traders exhibit the same cognitive errors. This suggests biases are universal, not tied to wealth. Another 2024 study highlighted the role of scarcity. When resources are tight, people focus on immediate needs. This amplifies biases like loss aversion. Traders under financial stress may make riskier bets, creating opportunities for disciplined investors. Technology is also changing how we exploit biases. Algorithms now detect patterns of irrational behavior. High-frequency trading firms use this to their advantage. They capitalize on short-term mispricings. Retail traders can learn from this approach. Use data-driven tools to spot anomalies, but avoid over-relying on automated systems. Human judgment still plays a critical role. Let's discuss some practical strategies for traders. One approach is contrarian investing. Go against the crowd when sentiment is extreme. Buy when others are selling in panic, or sell when euphoria drives prices too high. This leverages herd mentality and loss aversion. Another strategy is momentum trading. Ride the wave of trending stocks, but set clear exit points to avoid crashes. Use technical indicators like moving averages. This capitalizes on overconfidence and herd behavior. Value investing is another powerful approach. Seek out stocks trading below their intrinsic value. Look for low price-to-book or price-to-earnings ratios. This exploits biases like familiarity and anchoring. Finally, consider event-driven trading. Act quickly on earnings reports or news. This takes advantage of underreaction to new information, but always verify the data to avoid confirmation bias. These strategies require discipline and patience. Emotional trading is the enemy of success. Let's wrap up with some key takeaways. Behavioral economics reveals why markets are irrational. Cognitive biases like loss aversion and herd mentality create predictable patterns you can exploit. Market anomalies like momentum and value effects offer opportunities for disciplined traders. Stay aware of your own biases. Use data, rules, and diverse perspectives to stay grounded. With practice, you can turn biases into profits. Thanks for watching this deep dive. Subscribe for more insights on markets and trading, and let us know your thoughts in the comments below.